Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from European taxes to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar Two engine, powered by Beacon, is a game changer for Pillar Two compliance, provision, and modeling calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar Two tax experts from around the globe. PwC's Pillar Two engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in Prague, Czechia, at PwC's Global Transfer Pricing, Customs, and Indirect Tax Conference, where I'm excited to have Pieter Dere back on the podcast. Pieter is a partner in PwC's Belgium International Tax Services practice, where he leads Belgium's Pillar Two initiative. Pieter is also a fellow podcast host called the Tax Bites podcast. Pieter, welcome back to the podcast.
Very excited to be here, Doug.
Well, it's been a couple years since you've been on. When you were last on, we were talking about the enactment of the Pillar Two rules in Belgium, and now we're going to get into some of the nitty-gritty compliance. Belgium is leading the way globally here on Pillar Two compliance. But before we get into that, Pieter, we share a common love of cooking. I hope you're a better cook than I am, but I think we both enjoy cooking for our families. What is the favorite thing you like to prepare for your family when you're cooking at home?
Well, the favorite thing I like to make for my family is fresh pasta. For the sole reason, it's something my kids love very much. And if I see my family eat well and enjoy the food, then I'm happy. So I like to make fresh pasta.
Is there anything you like to cook that your family is not a big fan of, but you still enjoy cooking it?
Steak tartare. They don't like it, but I love it.
I love steak tartare.
Every now and then.
So this is an issue. I don't have any kids, but my wife is a vegetarian. So steak tartare is definitely not on the list, but something I do enjoy.
Voila. Then we have that in common, Doc.
Then we have that in common. All right. So let's get into Belgium, specifically Pillar Two compliance. There was a draft law that came out October 10th, 2025, but maybe just let's stepping back. In Belgium, we have the QDMTT, Income Inclusion Rule, UTPR, all applicable as of 2024. What are the due dates for Belgium? And maybe just at a high level, what are some of the compliance obligations for those that are operating in Belgium?
Yes, it's a very good point. So indeed, I can confirm Belgium has fully enacted Pillar Two already many months ago. So 24 is the first year in scope, as you rightfully say. Already Belgian taxpayers had to notify and register with the Belgian tax authorities. Also for that, Belgium was one of the first countries in the world. It happened already June last year. Notification is the first thing you need to do as a Belgian taxpayer. I hope everyone has done it. If not, you can still do it. There were no penalties on late registrations, etc. So some companies still need to register and need to do that ASAP. Why? Because you need a Belgian tax identification number for Pillar 2 specifically to file your QDMTT return. And if you have a calendar year ending end of December 2024, that deadline is for the time being still 30 November 25. So as we record this in October, very soon.
Yeah, so said again, just because this is very important for calendar year filers, so they'll have the financial systems that are based on calendar year. It's 11 months, right, after the end of that calendar or fiscal year. So for calendar year filers, it's end of November 2025 is when the Belgian return is due, and if your fiscal year, it's 11 months after the end of that fiscal year.
Exactly, 11 months after. So what does that now look like? There's a bit of debate at this moment in Belgium on this deadline. Why is that? The Belgian tax authorities have not yet published the final QDMTT return. A draft has been circulating for quite some time, so we do know what will be needed in the return. Taxpayers can prepare on that basis, but there's no final return yet, and we are 6 weeks before the filing deadline. So there are a lot of voices in Belgium saying, is this reasonable? Can we expect taxpayers to file a return if you only have 6 weeks or less after the publication of the tax form? There is an idea that the deadline should be extended. However, the deadline of 30 November has not been chosen by accident. It is the last moment that the tax authorities can still assess the QDMTT tax in 2025. There is a budgetary aspect to this deadline, Doc.
That's why we have the November deadline.
Yes.
We're going to come back to how the actual return submitted and this draft form. But before we do that, just a couple of bigger picture points. The first is, my understanding in Belgium is that this was a clarification, kind of, I want to put in air quotes, a clarification of existing law, because I think, as we discussed even a couple years ago, Belgium cannot go back and do retroactive changes to the law. Can you shed a little light on that?
Yeah, so you refer now indeed to the law that has very recently been published in draft, which the tax authorities still have to the Parliament, I must say, still has to approve formally before year end, that should be. And this is a clarification law. Let me give one example. In Belgium, we have two official languages in draft legislation, Dutch and French. They're basically put next to each other in the draft law. And there were just differences between the Dutch and the French text of law.
In Belgium.
Even in Belgium. So some of the exclusions for Pillar 2 were included in the Dutch text and were not included in the French text. This needs to be clarified. There were other uncertainties. I'm sure we're going to talk about it, but it was about how to file the return. What exactly is a GV? Some of the definitions. All of that needs to be crystal clear for taxpayers to file a correct tax return. Now, this legislation, in principle, tax authorities cannot go back retroactively, but this draft law actually explains that this is a mere clarification, that they have always had the intention to closely follow the OECD definitions, and this is just an adaptation of the previous law to clarify some aspects, and they go retroactively to 2024, actually to December 23, the first day that Pillar 2 was enacted in Belgium.
Yeah, I find this very interesting because I'm wondering, even outside the context of compliance, is this sort of clarification a way that certain jurisdictions that have issues with retroactivity, particularly as we think about the G7 agreement and the potential side-by-side agreement. I'm interested to see if other countries that have constitutional limitations on the retroactivity of tax or try to use this clarification. Then it'll also be interesting to see if people in those countries would potentially want to litigate some of those issues. So I find that particularly interesting in Belgium. All right, so let's move on to some of the specifics of this October 10th, 2025 draft law related to the Belgian compliance. The first piece was related to this electronic platform and the actual filing of the Belgian returns. What did that say?
Yeah, there was a bit of unclarity how exactly the Belgian compliance had to be shared with the authorities and so on. Now, it's made very clear the Belgian authorities will go for an e-platform. All communication regarding Pillar 2 will have to run via that platform. So the Belgian company that will be the representative of the group in Belgium will be able to access that electronic platform and upload XML type of format, the tax return, and all other information regarding Pillar 2. So one platform, one source of truth, that's the idea of the tax authorities.
And XML is the standard for both the Global Information Return and the QDMTT, even if you meet the transitional safe harbors?
Yeah, so first of all, XML has been the standard for all other types of filings in the same space. So although we need the final publication of the form, we generally expect it will all be XML, just like in the past. And indeed, even if you are fully in the safe harbors, you still need to file your tax return in Belgium by 30 November 25 if you have calendar year as end year. I must say, Doug, that we do expect, again, final form to be published, that if you meet the safe harbors, your tax return will be much more simplified than if you don't meet the safe harbors.
But I think the important thing for taxpayers and listeners to make sure that they understand is that if they've done, for example, the transitional safe harbor calculations themselves on a spreadsheet or whatever, even if they then have the Belgian QDMTT form, it still needs to be filed via XML. And that is generally technology that many taxpayers don't have internally. And so just important to remember that it's actually an XML. And I assume that is going to be the standard globally. Let me say, I hope that there is a consistent standard globally for submitting those returns. But I think some taxpayers may believe, well, that there may be a form or something that they can kind of hard code or whatever. And unfortunately, it needs to be done in the XML format. And it sounds like that's been the standard in Belgium, but certainly not necessarily the standard around the globe.
Yeah, and we have seen that with the notification in Belgium as well. There was then on the platform of the authorities the ability to do it line by line manually. You could not save that. As soon as you made a small error, you had to start all over again. It was a nightmare. So you really need to find, I think, solid alternatives to create that XML apart from the manual input, I think.
Absolutely. Okay, so moving on from the electronic platform and some of those specific filing, there were some questions about JVs in Belgium that got some press. What were those issues?
Yeah, if you took the law as published in 24, it was not crystal clear whether a JV was now actually in scope of Pillar 2 QDMTT or not. The update makes it very clear that it was always the intention, it's a clarification, that JVs effectively will be subject to a filing in Belgium, QDMTT return and assessment if need be. So that has been made crystal clear now. There's no doubt if that law effectively is passed.
Okay. There was also some guidance with respect to Belgium, what it's called their assessment system. And one of the things that I found interesting was that the Globe Information Return does not qualify as a tax return, but the QDMTT and something referred to as a simplified GIR or TTIR, which I learned stands for the total taxable income reflected in the financial statements. Help shed some light on that, because I think some were a bit confused as to the approach Belgium was taking on that.
Yeah. Well, so in Belgium, we have very specific procedures for tax assessments, tax returns, etc. So that was also not extremely clear in the law. And now the update is that effectively for the QDMTT return and UTPR returns, for the actual tax returns, a reference is made to the existing procedural framework for tax assessments in Belgium. That helps because it's a framework, it's legislation that is known for other tax filings and is known by hopefully a lot of taxpayers. So it brings some, it takes away some uncertainty out of the system. Indeed, the Global Information Return is not a tax assessment, strictly speaking. It is information that will be shared with the authorities via the same e-platform, so that will all be the same, but it doesn't follow with a tax assessment and so on. From a procedural perspective, that is completely different. Okay. This has now been very much clarified in the law.
And so what is the simplified GIR? Because for, let's say, a Belgian parented group that potentially has an income inclusion rule pickup, where does that potential tax liability show up on a tax return, and how does that potential assessment work on that?
Yeah, so a Belgian UPA will have to file a fully fledged information return, of course, with all the details of the group in Belgium. That's, of course, not by 30 November, but later on, by end of June for calendar years, end of June 26.
Yeah, good point.
But of course, if you are just a Belgian company within a chain of companies and the information is filed somewhere else, you will also have to indicate which entity is actually filing the complete information return. And if that is in a country, I'm sure we're going to come to that point later on, which has an exchange of information agreement with Belgium or within the European Union and can rely on the European framework, then you don't need to refile that information again in Belgium. Belgian authorities will have access to the filing that has been done outside of Belgium.
Got it. All right, and then if there's a number of Belgian entities within a particular group, there is something that was referred to in the law called the general representative. So tell us a little bit about that.
Yeah, this is a Belgian solution, I can say, to the fact that in Belgium we have never known a group tax assessment. So we tax individual legal entities. It has always been that. No consolidation. So we're not used to that. Our systems in the Belgian tax administration are also not adapted for that. So the Belgian solution is, on the one hand, all companies need to be liable for the potential assessment. It's not because one entity is the representative and, for instance, doesn't pay the taxes that they cannot take the money from other entities in the group. So the assessment will cover, formally it will be an assessment for all entities in Belgium, but of course practically you need a representative. You need one entity that you can have the interaction with, and that will be your representative in Belgium. They make it quite easy. The representative is in fact the entity that will file the tax return. So you can basically choose and then have one entity file your tax return. If you don't file the tax return, then the representative is always the UPE, if that entity is in Belgium. A holding company, which is most logic, if the holding company is holding all the other Belgian entities, your holding company will be the representative for the tax authorities. If you have not even that, then they just pick the one with the largest balance sheet. So probably the most creditworthy in their reasoning entity in Belgium. That's the representative.
Got it. And just to make sure that the point was heard, that there is joint and several liability, so that because there's no consolidation, but if one taxpayer, if there's an assessment, there's joint and several liability within the so-called Belgium group for the Pillar Two group.
Yes, because it's an assessment covering all the legal entities based on I mentioned that they refer back to the normal tax procedures in Belgium. Mm-hmm. So there are various tools that the tax authorities can use if tax assessments are not paid. And they can do that against all the entities. Mm-hmm. Yeah.
All right, and then there was also some changes, I think, not just for Pillar Two, but just in general for Belgian compliance and the statute of limitations.
Yes. So 4 or 5 years ago, the Belgian government dramatically extended the statute of limitation. Where the normal statute was 3 to 4 years, it was now up to 10 years of statute of limitation. That has been considered a little bit problematic from a legal certainty perspective, and that has been turned around by the government a few months ago. So the statute of limitation has generally been reduced to 3, 4, up to 6 for complex returns. And now also the Pillar 2 statute of limitation will be adapted and will be brought back from 10 years to that 6-year period, basically.
All right. So we're, as I think you mentioned earlier, we're recording this on October 21st. This is a very dynamic area. Again, to stress for calendar year filers, the QDMTT, if you operate in Belgium, is going to be due at the end of November. Should taxpayers wait till this is finalized? When will this be finalized? We have a draft form. We already have the XML built within our Pillar 2 engine. Should companies wait till this is finalized? What is your advice with respect for taxpayers that are calendar year that have a potential filing obligation at the end of November?
Yeah, very clearly I would prepare for the return. Even if the deadline in the end is a little bit extended, you're prepared, you're ready. Do the transitional safe harbor calculation for Belgium. Make sure you have that data. Decide who will be your representative. Use the draft form that is available. If you can complete that form, should be fine. But especially for taxpayers that drop out of the safe harbors, maybe for a good reason, a reorganization or some other reason, then yeah, you need to have the full Pillar 2 calculation ready for Belgium by end of November. So if you haven't done that yet, it's time to get into action, I think.
Yeah. We think that the OECD has said that there are 7,000 multinational enterprises in scope of Pillar 2. Based on some of the analysis that we've done, I think it's closer to 10,000 multinationals that have greater than 750 million euro top line revenue that operate in at least one of the countries that has implemented these Pillar 2 rules. So that is a massive amount of companies that are going to need to prepare. And I think some may have even hoped that all this was going to go away with the G7 agreement. We'll come back to that a little bit later, but the filing requirements are the filing requirements as enacted in Belgian law and any other laws around the rest of the world. Here's a question, Peter, I get as I travel around the globe. What if I just don't file? Maybe all of this is going away. What if I don't file? Yeah. What's your response to that in Belgium?
Yeah, well, my response is that probably meeting the 30 November deadline is for 80% of those 10,000 or whatever number of multinationals actually very doable. If you prepare, if you use software like our engine, you should be able to meet the deadline. So my question is always, why not meet the deadline? If you don't meet it, there are penalties. Unlike for the notification last year, there are penalties. It's like a normal tax return you don't file. If you for good reasons, with good faith, don't file the tax return, it's not an enormous amount, the first penalty. However, it makes you tick in a higher box the next time you make an error in your compliance in Belgium. So why take that chance? And it's not if you have Pillar 2 taxes which are due, it's not by not filing the return that the tax authorities will not get the Pillar 2 taxes. There are various options. They can hold you liable, ex officio assessments, which is basically tax authorities just imposing the assessment without you filing a return. So I don't see that to be a very constructive move to your relationship with the authorities in Belgium.
Yeah, and obviously the reputational issues and my response to that, not specific to Belgium, is, well, if you operate in a loss in a particular jurisdiction and you don't have a corporate tax liability, because I think some will say, oh, well, we meet the transitional safe harbor, we're not anticipating a tax within a particular jurisdiction. In a corporate tax and a direct corporate tax environment, if you operate in an NOL, companies would not file a corporate income tax return just because they didn't have a tax liability. So many reasons for companies that are in scope to get ready and to file.
Yeah.
All right. So want to move on. We're still going to stick with Pillar 2, but sort of maybe taking a step back to DAC 9. I haven't spent a lot of time on the podcast with DAC 9. Maybe if you could share with listeners, what is DAC 9 and why is this important in Europe related to Pillar 2?
Yeah. DAC 9 is a European directive, a piece of legislation for Europe. It's called Directive Administrative Cooperation. And the 9 means it's the 8th update of that directive, which has been in place for a long time in Europe. It is the legislative basis for cooperation between tax authorities in Europe.
In the EU.
In the EU. Thanks, Doc.
One of our UK colleagues reminded me that technically that the UK is still in Europe, but not part of the European Union.
That is, I fully get it.
That is a fact.
Thanks for that, Doc. You keep me sharp here. Now, and some may remember DAC 6 and other pleasant legislations for reporting. DAC 9 is basically including the agreements to exchange information on Pillar 2 within the European Union. So it's an update of that existing framework to extend it to Pillar 2. The idea is also like the OECD has the same idea or the same principle. As a taxpayer, you should only file your information once in the EU, and then tax authorities can use this directive as a legal basis to exchange the information. So that's the background. So, but it's a directive, Doc. So do remind that every country has to implement the directive in national legislation. So all the member states still have to enact legislation to reflect these exchange of information and principles.
And I think the requirement for DAC 9 is to be implemented before the end of 2025. And is Belgium? I don't know. Is Belgium? I don't think Belgium signed up yet.
It's not yet formally enacted. There is a draft law circulating between. The different political parties in Belgium just to get ready for implementation. For all I know, my best guess is that Belgium effectively will meet that deadline, and they committed to do it. So
Okay. So let's move on to the multilateral competent authority agreement. So this was something that has been proposed by the OECD for Pillar 2, and it's kind of like DAC 9 for the globe, right? That will allow various jurisdictions to be able to share Pillar 2 compliance obligations. Has Belgium signed up for that?
Yes, Belgium has signed up for that, but not that many countries. If I always start from the idea that 140 countries are in the inclusive framework, I think only less than 20, if I'm well informed today, have signed up for this agreement. So,
if we're both well informed, the number that I had as of mid-October was 17 countries.
All right.
I think I have expressed on the podcast some skepticism of how many countries will actually sign the MCAA before we get to June 30th of next year. I mean, in my view, that's really obviously the really important deadline. So this could create some challenges for taxpayers and taxing authorities with respect to the Globe Information Return. Of course, my concern is that taxpayers may be required to file the Globe Information Return in multiple different countries if we don't have the MCAA. And obviously the whole vision of the system was that we'd have one consistent form in an XML format that is shared with either the UPE territory, or if you're in a jurisdiction that does not have the pillar, where your UPE is not in Pillar 2, you would pick a designated filing entity and have to file the return once. And I would really encourage any policymakers who do listen to this podcast that is really important for the administration of this system. But we'll see. Again, I do have some skepticism with respect to the ability and the whether countries, and particularly with all the politics going on with the G7, whether that will happen. All right, so let's move on. We mentioned the G7 agreement and the potential side-by-side agreement. Bloomberg reported a couple months ago, we talked about this on the podcast maybe a little over a month ago, that something specific, they said that Belgium and Estonia had said that the system could impact their tax sovereignty. So this was in the context of after the G7 agreement, there were some leaked emails, and there were a couple press reports, which obviously, take it for what it's worth as far as that was reported in the press. But I'm interested in your views. What are Belgian taxpayers' view on this with respect to the side-by-side agreement? The OECD is still saying that there will be a side-by-side agreement, which presumably is in the form of some type of administrative guidance. My guess is it's going to have to be some form of safe harbor, because the U.S. GILTI system, or now so-called necktie system, because it's blending, will not be a qualifying IAR. But what are you hearing in Belgium from taxpayers? What's your thoughts on the side-by-side agreement and where that could be heading from a Belgian perspective before the end of the year?
Yeah, I think that it's obviously very, very important topic. It's been discussed a lot between taxpayers, especially, of course, taxpayers confronted with a 30 November deadline with an US headquartered, part of a US headquartered group, of course, because there the question will be, should we now file this return or not? What should we put in there? And especially if you are a taxpayer potentially subject to QDMTT in Belgium, because then the outcome of the side-by-side agreement could have a significant impact in Belgium. And there, I guess, that a lot of taxpayers are wondering, even if the deadline of 30 November is not moved, what should I do? Because then I could have filing a return, correcting it afterwards. It could be quite a mess. There is no official position or statement, as far as I'm aware, by the Belgian authorities. But of course, if I would be in their shoes, I understand why this statement in Bloomberg was made, of course, as a smaller country, I must say, in the EU. This could have a big impact. We have a lot of activities in Belgium from US headquartered groups, and it could have a big impact, I think, on the overall Pillar 2 collection and taxes.
Yeah, just maybe one clarification to that point, particularly for U.S. parented groups, or frankly any group that's parented in a jurisdiction that has not implemented the Pillar 2 rules. The G7 agreement is silent on QDMTTs, right? And for calendar year filers, if you're a U.S. parented group, you are going to QDMTTs are here to stay. And even the OECD has said publicly that they've really, in my view, changed the messaging a bit, that now all of a sudden the QDMTTs, which weren't even a part of the original model rules, are now sort of the central policy concept for Pillar 2, and that they want jurisdictions to now implement the QDMTTs. So for US parented groups, or if you're a calendar year filer and you operate in Belgium, get started or get that QDMTT completed before November 30th. I think the bigger question is whether the UTPR and the IAR could apply for US multinationals, and that's what the Trump administration is advocating, that for companies that are subject to necktie, or historically known as GILTI, that neither the UTPR nor the income inclusion rule should apply for US parented groups. And so that, I think, is your point, that to the extent that you have a Belgian holding company, let's say, and then that Belgian holding company owns the rest of the world or other foreign subsidiaries, does that Belgium income inclusion rule in 2024 apply for US parented groups? And we don't know, right? And we have no idea what the side-by-side agreement. This goes back to the earlier point on the clarification of law. because one of the things that we talked about even on the original podcast was the inability for Belgium to be able to go back and retroactively change its rules. I'm very interested to see, if there is a side-by-side agreement that would accept U.S. parented groups, will the IIR still apply for U.S. multinationals in 2024? Is this going to be prospective? There are a number of other jurisdictions that have constitutional limitations. So my suggestion is file those QDMTTs if you're subject to the Belgian IIR. Assume that it's going to apply in 2024. And particularly if you have a potential top-up tax with the IIR, the failure to file could result in the penalties that you described. But really, it's just a tremendous amount of uncertainty for taxpayers. But if there is any certainty in this, in my view, it is the QDMTTs. And then you'll just need to keep an eye on what happens with this G7 agreement.
Yeah. And be reminded, Doc, in Belgium, we have the system of advanced taxpayers. So not knowing how much income inclusion tax you have to pay in Belgium or the uncertainty around it makes it extremely difficult to predict and make correct tax prepayments.
Yeah, you're one of the few jurisdictions in the U.S. has this as sort of what we refer to as estimated payments. And so you have to make quarterly payments, and then remind me, a failure to do those estimated payments results in like a 6% or
tax increase. Yeah, automatically the top-up tax will increase with 6.75% if you don't do it.
Okay, almost 7%.
6.75. But anyhow,
okay,
that's too much detail.
I was pretty close
now.
with 6. I don't remember. I have no idea how I pulled that out of my brain. Okay, so maybe moving on to this Belgian case on the legality of the undertax profit rule. That has received some press this summer. And to remind listeners, the American Free Enterprise Chamber of Commerce filed a case with the Belgian Constitutional Court, which now has been referenced to the Court of Justice of the European Union, the CJEU. That's a mouthful. But maybe if you could shed a little bit of light on that, maybe remind listeners what is the case. We don't know, we need to go into some of the detailed mechanics of EU law, but maybe provide an overview, and then what can we expect with respect to timing? Because I do get a lot of questions from taxpayers. It's like, does this mean the UTPR is dead in the EU? And it's like, not so fast.
Yeah, indeed. So it is an important case, right? So as you mentioned, some stakeholders have filed a complaint with the Belgian Constitutional Court, claiming that the application of the UTPR rules in Belgium, because it's a Belgian case, could end up in some situations that violate principles of Belgian or European fundamental principles. For instance, private property. The famous example is that under UTPR, a Belgian entity could receive a tax assessment which is way higher than the profit it's making, because it could pay taxes for profits outside of Belgium. So that is a typical example showing that there could be a tension with the right of private property. Now, there were, for me, two important questions in the case before the Constitutional Court. Is it an acceptable case? Was there a valid interest of the parties filing the case? And secondly, what will the court then do to solve the technical question itself? Important is that first question was answered with, yes, there was a valid stake. So the court accepted the case and indeed referred it to the European Court, which will now have to come up with a decision. That will take several months. That's normal. And we'll have to answer some of the fundamental questions. Is UTPR violating principles of European law? Is it violating some of the directives? So this will be a very important question. And the consequence, if it would violate some of these principles, is that the law should be abolished. So, yeah.
And so my understanding is that we may not get a final ruling for well over a year, but that there are briefs that will be filed that could shed some light on the view of particular stakeholders.
Well, there is indeed now a procedure where parties will have the right to discuss this topic. Yeah, so we could get some indications, but a final decision will only come within several months.
Okay, all right. So that will be very interesting. And then maybe the one point on this, the freedom of property, I think is the way you described it, is that when Belgium implemented the UTPR, they did not limit the collection of taxes owed on the UTPR to the denial of deduction. So just to remind listeners,
yes,
the way the model rules were designed was that, if a small company had a potential UTPR top-up tax, that they would effectively be denied deductions up to the amount of the top-up tax. So effectively, a Pillar Two UTPR liability couldn't bankrupt a company. It could potentially subject them to gross-based taxation, and then the mechanics of the rules would have then said, well, additional UTPR liability would have been assessed in future years. It would have carried over on that gross basis of taxation system, or effectively the denial of deductions. What we've seen with many, if not most, of the jurisdictions that implemented the UTPR is they did not bring in that gross-based system, that denial of deductions, and instead said that the entire UTPR needs to be collected by the Belgium entity. And the point is that if you've got a tiny little Belgium subsidiary and then a huge low-tax jurisdiction that is subject to Pillar Two, it could bankrupt the Belgian entity and the ability to try to collect that top-up tax, whether it's an EU group or another group from a practical perspective. And that is just one of the technical issues that is subject to this particular case. All right, so we covered a lot there. Maybe to kind of wrap things up here, what advice do you have for multinationals that are getting ready for Pillar Two? I mean, Peter, you've been in the weeds from a technical perspective for Pillar Two, now from an operational perspective as companies are thinking about Pillar Two compliance. Maybe any last words that you have for taxpayers, and particularly calendar year taxpayers that are subject to Pillar Two?
Yeah, I would say prepare, be ready for that filing. But I've seen that there have been many cases where the devil is in the details, we say. And for Pillar Two, that's right. If you make then a detailed calculation on Pillar Two, there are always technical questions popping up and decisions that you need to take. So be prepared well in advance. Start today, because 30 November is still in the law as a deadline. That's my most important recommendation.
I think that's good advice. And I'll pile on a little bit, because I think particularly in Belgium, there are a lot of companies that plan to meet the transitional safe harbor. And my recommendation to those taxpayers is, if you're going to rely on the transitional safe harbor, make sure you have a qualifying country by country report. And there are a lot of potential issues, particularly with kind of post-period adjustments that would occur, whether those get reported in the financial statements and what year those get reported in the financial statements. When does that show up for purposes of the country-by-country report? That could potentially have swings also on the math to determine whether you meet the transitional safe harbor. And so would recommend spend some time with that country-by-country report. Make sure you're doing the math on the transitional safe harbor calc, because if you do have to do the full calc, that's obviously significantly additional work. And I've seen a number of taxpayers that, for whatever odd reasons, from an accounting perspective, whether it has to do with transfer pricing or whatever, end up failing the safe harbor, even though the statutory rate is well above 15%. All right. Well, Peter, always great to have you on. It's going to be very interesting times, I think, over very busy times for the next couple months, as really the less than a month to get these returns filed. And then obviously the Globe information return and the June 30th deadline is looming for in-scope multinationals as well. So look forward to having you back on and learning more about Belgium's approach.
It was a pleasure to be here, as always, Doug.
All right. Thank you, Peter. So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Pieter Dere, PwC Belgium International Tax Services Partner. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.